Cut. Live action? Live action. All right. Hey, what's up, North Shore? Dave Picardi, Liberty Realty here. We have an important meeting that we just scheduled, and I wanted to include you and everybody around the North Shore in on it. So home prices are absolutely skyrocketing. We all know that. That's all we're seeing in the market. The new thing that's a real problem now is interest rates are also skyrocketing. So we called an emergency meeting to come in and talk to the North Shore's #1 lender and see what's actually going on. All right, so come with me. Let's go talk to him.
What's up?
Hey, man. Good to see you.
Good to see you.
All right. All right, guys. Anthony Lapolla, NRL Mortgage, North Shore's #1 lender. Anytime we need to know any information about rates, what's going on, how to get deals done, this is the guy. So it's who I talk to, and it's definitely who you should talk to.
We appreciate that.
Yeah. All right, so interest rates going through the roof.
Yep.
Home prices going through the roof. Right? And you know, because you just bought a house.
Sure did.
Yeah, right in the middle of all this mess.
Crazy.
You bought a house.
Yep.
All right, so
That's how you know it's still good.
that's how you know it's still good. The
Yep.
lender's actually doing it too. So we have a few topics we definitely need to cover.
Yep.
All right, so first topic is, I guess, these interest rates.
Yeah.
Like, what's going on?
So the most important thing to remember is that rates were artificially low for all of COVID. The government was pumping money into the economy to keep rates low, to generate action in the economy and keep things moving. So everybody heard about rates in the 3s for the better part of 2 years. We're now in the 5s.
Yep.
We were in the 5s, touching 5 just before COVID at the end of 19. So I'm not calling this an increase. It's not out of the norm. It's more of just a normalization of where rates are and where they're headed. They've come up in a significant way as a result of inflation, which again gets back to the government pumping the economy full of money over the last couple of years. So as inflation has increased, rates have increased along with that. What's happening now is the Fed is trying to swing the other way. By raising the federal funds rate, they are trying to bring inflation down, which will in turn theoretically bring mortgage rates down. So we're in the mid to high 5s for the majority of borrowers right now.
Okay.
Should stabilize, kind of stay there, for at least a little while. I don't see them going anywhere in either direction dramatically in the short term.
Yeah.
As we get closer to the end of the year into 2023, as the Fed's actions kind of take hold and have their impact, we should see rates come back down a little bit. They'll probably never get back to the 3s, at least not anytime soon.
Okay.
But they'll stabilize, hopefully, upside or best case scenario, maybe mid to low 4s.
Okay, mid to low 4s. So
Yeah.
to put it in perspective, I'm not an old guy.
Yep.
Although I kind of am now. My first house, 6.5%.
Yep.
Right. So, and that was great.
Yep.
And then we refied it. I think it was 4.25, and it was like the thing. It's like no one could believe we got 4.25.
Right.
Now we're talking that maybe hopefully that's going to be like a normal thing.
It should. Yeah. It should come back. There's a lot that needs to happen. Nobody's got a crystal ball.
Yep.
We can only make assumptions.
Yeah.
But everything that we're seeing happen is with that in mind, is
Right.
that the rates will come back down.
Okay.
You said it. Late 90s, early 2000s, rates were in the 8s. Before that, they were even higher.
Mm-hmm.
So in the grand scheme of things, even with a rate in the mid to high 5s, it's historically low.
Right.
Over a 40-year period of time, if you strip out the last 2 years of the artificially low 3% rates, a rate in the 5s is still considered near historically low.
Correct.
So it's not terrible news overall.
All right. So I'm gonna throw a curveball at you.
Okay.
So just because you're the guy, you're the numbers guy. So one thing that even though Fed's raising interest rates and all that, so technically though the Fed raising interest rates not directly tied to
Apples and oranges.
The mortgage rate being high, right?
It has an impact,
right?
But it's not a direct correlation. And this time around, because of everything else that's happened with the government pumping money in, inflation being where it is, supply chain issues, the Fed raising rates this time around as a way to combat inflation is theoretically going to have the opposite effect on mortgage rates.
Okay.
But you can't equate the two. They're never a direct comparison.
Gotcha. Okay. Just wanted to throw that out there.
No,
that's something else. I've been seeing that a lot. Right?
Yeah.
So lenders will come on and act like they're trying to be smart with it.
Right.
But it's I think it's important to understand.
No, I'm glad you mentioned it, because I mean, 90% of the questions that I get around rates and around the federal funds rate is, well, the Fed's raising rates, so that means mortgage rates are going up next month, so I want to get in now.
Right.
It's not necessarily the case.
Because they could go up and mortgage rates could come down.
Right. They could go up and rates could go up. They can go up, rates could come down. Right. They could come down and rates could go up.
Right.
You know, it's a function of everything else that's happening in the economy. Mm-hmm. That is just one piece of it.
Gotcha.
Yeah.
All right. So the next concern.
Yep.
Right, so because historically, mm-hmm. rates in the 5s are normal. Mm-hmm. Okay. So, but what's not normal is the amount of equity being built in these properties.
Crazy equity.
Overnight. So, you know, if you said, yeah, the average rate's 5.5%, you know, but we're talking on a $400,000 house 15 years ago.
Right.
You know, so, but now that same house is worth $800,000.
Yep.
Right. So the payments are going up. You know, so what's the, I guess, short term? What is our, I have a lot of buyers running around, extremely well qualified. You know, 2 years ago, we would have been slam dunk in every single house we put an offer in on.
Yep.
Now, with mid-pack, you know, you have to, like, there's a lot of variables that are going into these now that to win a house, you have to be, like, all in. It's like the draft. You're giving up next year's draft picks.
Right.
You know what I mean? Like, you're, like, really all in on these things. And you're saying, hopefully we pick, you know, the equity will continue to rise and we'll be fine, which is what's been going on.
Yep.
But what should be the game plan for the next, you know, so say this spring market as it finishes up, you know, as we get into next year, like what does it look like?
I think the biggest consideration is just having an understanding that a borrower on average is going to qualify for less with rates in the 5s than they may have last year at this time with rates in the 3s.
Okay.
Could be an $80,000 to $100,000 difference in buying power. Doesn't mean you have to be out of the market. Just means you have to shift your expectations a little bit. Prices have been going up purely as a result of supply and demand.
Right.
There's so much demand and very little supply. So that's pushing prices up. I don't see that turning around anytime soon.
Yeah. I'm probably going to do a lot of talking about that in the next couple of weeks.
Yeah, I mean, the balance of supply and demand is what's going to generate a response or a reaction,
right.
You know, with meaning prices coming down.
Right.
Prices probably aren't coming down anytime soon.
No, they can't.
They can't.
Right.
If anything, we might see double-digit appreciation for another 2 years.
Yeah, well, it looks like that's probably going to happen.
Right.
Which is crazy to think about, but it's the reality.
Yeah.
You know, so yeah, and like I said, I'm gonna put some more content out on that because I hear, you know, all these people telling you all the stuff that they know is true in the market, and houses the prices go up and down, you know, and you just. I don't know who's talking to them or where they're even hearing the information,
right.
but it's just not true.
I mean, most of the time it's the news.
Well, right.
You know, and the news is 30 days behind on the cycle.
Right.
I just saw yesterday that they announced that rates are at 5.3%. Well, we were at 5.3% 45 days ago.
Yeah, right.
You know, now we're at like 5.75, 5.875 for the majority of people. You know, there's always exceptions to the rule. Yeah, I mean, on the equity side, on the appreciation side, you know, you may have to pay a little bit more for a home today. Mm-hmm. But at the same time, that home's going to be worth more 6 months from now, 12 months from now, 2 years from now.
Correct.
The only time that values have come down in any measurable way was 08, 09, you know, 2010 to 12 during the financial crisis.
Yeah, so it was banking fraud.
Well, the mortgage industry was essentially the catalyst for that collapse, which is completely opposite of what's happening today.
Right.
So we're not really at a risk of seeing that again, at least not in this environment.
Right.
But yeah, I mean, you know, you may have to pay a little more because that's what the market is dictating.
Yeah.
But the appreciation will continue. So to your point about building equity, anybody that bought a home in the last couple of years or is buying now is building all kinds of equity overnight. You know, when we use that term loosely, but you know, within a couple of months or a year, the equity is just through the roof.
Yeah.
So
you have an example of that.
I do have an example.
You haven't even closed on a new house, and you already have equity.
It's true.
It's true.
Yeah.
Right. So. The purchase price was way above asking, and the appraisal came in way above that.
Yep.
Right?
So we won. But we had a good strategy. We had a good plan. We put it together. We knew what we wanted.
Oh, yeah.
And we went and got it.
Yes.
So that's where the team that you're working with, the people you're working with, they do matter. Who you work with does matter.
Oh, it's night and day.
Night and day.
Yeah. The industry with lenders and real estate agents.
Well, that's what I mean.
There's a majority of them that. Like as an example, say 15 offers come in on a property, I might talk to one agent meaningfully out of that. And then there's a whole slew of them. I have no idea who they even are, but they're submitting offers.
Yep.
And you're just thinking, wow, like all these buyers, and you just have the wrong
representation.
Right.
I mean, we've seen it firsthand, with some of the deals that we've worked on, where half the reason we get those deals under contract is your work, at the front of the line, having those conversations, getting it all set up. My work behind the scenes, making sure it all checks out. These are the intangibles that are important.
Super important.
Yeah.
That's why that numbers are so high.
Right.
Yeah.
Oh yeah.
That's right. So let's talk one more thing then. So, the concern is that, I have buyers like this that 3 years ago got out of the market because they were waiting for the market to come back down, right? And now 3 years later, it's, like I one
30% higher.
He's made really ruined it for his family type thing where it's like, because it's like, I can't believe we did this.
Yep.
So the ultimate play is you have to stay in the market because something always happens. Eventually you'll get something.
Yep.
And then that gives you more leverage over the next 3 to 5 years.
Absolutely.
As opposed to being out of the market, you can't save enough money to beat the appreciation that's going on in the market right now.
Can't.
So if you saved 40, 50 grand over the next year, the appreciation beats you, and the money didn't even go anywhere.
Yeah, you didn't really make a dent in the overall grand scheme of things.
That's right.
Yeah, I firmly believe that staying in the market is very, very important. If you are planning to or need to buy a home for any variety of reasons, again, maybe you have to stretch a little bit further than you wanted to. Maybe you got to get a little bit more creative. Maybe the price range has to shift around. Mm-hmm. But the opportunity to buy a house is still there. And if you wait a year or 2 years, you're going to be buying the same house at a much higher price. Right. And who knows where rates are? We think they're going to come down.
Yeah, they could go up.
Hopefully they do, but they could go up.
Right.
So if you're looking at a house today that's $400,000, maybe a year and a half
Where is that? I want to know, where's that house? Everybody wants to know, where's that house?
But let's use 500 then, or 6, whatever the number is. If you're going to buy that house today for that price, that same house theoretically 2 years from now is worth $100,000 more.
Right.
So your income, your savings has to keep pace with that.
Right.
Or you're buying a house, not an interest rate. You can always refinance the rate.
And that's the big thing too. Is so if I buy now and I'm at almost 6%.
Yep.
And I'm buying. Not to put you on the spot, but an average, say it was a 600 or 650 in the area, right?
Yep.
Entry level at this point,
mm-hmm.
right? So, and I'm paying that 6% interest rate, and a year from now, the interest rates level down, and maybe they're at 4.5%.
Yep.
And I'm saving a percent and a half on the interest rate. I mean, my mortgage payment's going to drop
significantly. Yeah,
right.
I mean, a few $100s at a minimum, just off the top of my head. A 1.5 on 600.
Right.
Is going to have an impact. It's definitely going to make it more comfortable.
Right.
So I think that's the other thing is, stretch as far as you can comfortably, knowing that on the horizon there is a refinance opportunity we think that is coming together.
Right.
So if you got to push a little bit further today, hopefully within the next 6 to 12 months, there's a way to make that a little bit more comfortable.
Cool. All right.
Yeah.
This is good. Hopefully this helps some people.
I hope so.
Yeah. So our emergency, maybe it's crisis averted. Maybe we're all set.
I don't think there's a crisis.
No.
I think if anything, we have an inventory problem, not a rate problem.
No, right. Yeah. And that inventory problem's, it's there forever at this point.
Yeah, I think we're starting to see it turn a little bit.
Right.
The increase in rates has for sure pushed a few people out of the market, whether that's their own decision or whatever it may be. We're kind of saying the opposite. We're encouraging people to stay in the market because there is opportunity there.
Oh, yeah.
But it's really not going to change. There's more inventory hitting. There's less buyers. Maybe that means less offers. Maybe that means instead of 20 offers on a house, you're still getting 5 or 6.
Yeah.
Still multiple offer situations.
Yeah. I just had an offer accepted, or we did last weekend. I got the phone call, and I'm very confident on offers. We put in really good offers.
Yep. Strong.
And it's not just the number, it's how it's written, it's the language it's written, it's what we got, right? So we always put together well thought out, strong offers.
Yep.
And lately in the market, it's just been like, yeah, we know we're putting them in, we know we don't have a chance.
Right.
And we had a 3.5% FHA offer accepted on a property.
Yep.
And I was like, you sure you're calling the right agent? Right?
Those have been tough.
Those have been extremely tough.
Yeah.
All those people that are in that spot
Yep.
they've been going up against 20% down or more.
Or cash buyers.
Yeah. And it's just, you feel bad, but at this point, it looks like maybe it's starting to, that would be beautiful if that eases up a little bit.
Just a little bit of balance is all we need.
Yeah.
I mean, we think that the inventory is going to stay low for, again, a number of reasons.
Yeah.
But yeah, I mean, I think it's all pointing towards the same thing.
Very good. All right.
Cool.
This has been good. We'll probably stop in again a couple times.
Feel free anytime.
Yeah. All right.
I'd love to help.
All right, man. Thank you.
Thank you.
Cut.